We're about to expose the largest institutional wealth destruction event in American real estate history, and the mainstream media is staying silent. While everyone focuses on individual homeowners losing equity, a much bigger story is unfolding behind the scenes. Wall Street's $2 trillion real estate gamble that began during the pandemic is now collapsing in real time. According to the latest Zillow data, this may be the most spectacular institutional failure since 2008. Zillow's latest report shows that 53% of homes are now depreciating year over year, the highest rate since April 2012. But dig deeper into who owns these depreciating properties, and a disturbing pattern emerges. Institutional investors who purchased millions of homes at peak prices in 2021 and 2022 are now sitting on what insiders call the biggest bag hold in history. The true cost of pandemic-era buying. During the pandemic, institutional investors scooped up over 300,000 single-family homes. Companies like Invitation Homes, American Homes for Rent, and Progress Residential went on an unprecedented buying spree, acquiring entire neighborhoods and routinely paying 20 to 30% above asking price. According to CoreLogic data, institutional investors paid an average of $420,000 per home during the 2021 to 22 peak. Based on current Zillow valuations, those same properties are now worth an average of $365,000. That's a $55,000 loss per home, before factoring in carrying costs, property taxes, insurance, and maintenance. Quick math, 300,000 homes times $55,000 in paper losses equals $16.5 billion. And that's just the beginning. It gets worse. These institutional buyers didn't pay cash. Many were heavily leveraged, borrowing against 70 to 80% of their existing portfolios to finance acquisitions. When underlying asset values drop 15%, they face what Wall Street calls a margin compression event, or in plain English, they're getting squeezed. Your retirement is on the line. Here's the truly terrifying part. The institutional money pouring into real estate didn't just come from private equity. According to SEC filings, major pension funds, including CalPERS, the Texas Teachers Retirement System, and the Florida State Board of Administration, invested billions in residential real estate funds during the pandemic. Your retirement savings were used to buy homes at market peaks. CalPERS alone allocated $2.4 billion to real estate funds that were aggressively buying single-family homes in 2021 to 22. The Texas Teachers Fund put in $1.8 billion. These aren't small positions. They represent significant portions of the retirement assets of millions of Americans. Now, according to the latest pension fund disclosures, these real estate allocations are showing negative returns for the first time since 2009. The Texas Teachers Fund recently reported a negative 3.2% return on its real estate investments, with expectations of significant headwinds through 2026. Ground zero for the collapse. Zillow's data shows that the areas where institutional investors concentrated their purchases are exactly where values are dropping fastest. Florida, Texas, Arizona, North Carolina, Georgia, the darlings of pandemic-era institutional buying, are now ground zero for a real estate value collapse. Take Florida. Zillow reports condo values down 9.9% year over year, the steepest decline since 2009. But single-family homes, where institutional money was primarily concentrated, are down 4.9%. That might not sound catastrophic until you realize institutional investors own roughly 40,000 single-family homes in Florida alone. City-by-city carnage. Tampa Bay. Institutional investors own over 8,000 properties, purchased at an average of $385,000 between 2021 and 2022. Current Zillow valuations put them at $340,000. That's $45,000 in losses per home, $360 million in wealth destruction. Miami-Dade. Institutional buyers acquired 12,000 homes at an average of $520,000. Today, Zillow values them at $465,000. That's $660 million in losses in a single county. But the worst institutional performer? Austin, Texas. Tech money and Wall Street real estate funds collided in a perfect storm of overbidding. Institutional investors bought 6,500 homes at an average of $475,000. Current valuations, $380,000. A staggering $95,000 loss per home. $617 million in wealth destruction. American Homes for Rent, in their latest quarterly filing, acknowledged significant headwinds in property valuations across their Florida portfolio. Translation, they're hemorrhaging money. Pressure from every direction. These institutional investors aren't small landlords who can wait out a market recovery. They have shareholders, debt obligations, and quarterly earnings targets to hit. When asset values decline this rapidly, they're forced into tough decisions, with pressure mounting from multiple directions. Insurance companies that underwrote loans for these institutional buyers are now demanding additional collateral. Wells Fargo recently sent notices to 3 major real estate funds requiring additional equity contributions due to loan-to-value covenant violations. Bank of America has quietly reduced credit lines for 2 institutional buyers by a combined $800 million. Meanwhile, rating agencies have begun downgrading real estate investment trusts heavily exposed to single-family homes. Moody's placed 4 major REITs on negative watch, citing deteriorating fundamentals in their target markets. Lower credit ratings mean higher borrowing costs, further squeezing already razor-thin margins. The cracks are showing. Invitation Homes recently announced they're exploring strategic alternatives for portions of their portfolio. Industry speak for, "We need to sell before things get worse." Progress Residential has quietly listed over 2,000 properties for sale in the past 6 months. American Homes for Rent has paused acquisitions entirely. A liquidity event is coming. When institutional investors start dumping properties at scale, it creates what economists call a liquidity event. Markets that were starved for inventory suddenly get flooded with institutional-grade homes priced below what they were purchased for. According to Realtor.com data, we're already watching this unfold. Active listings nationwide are up 15% year-over-year, with inventory hitting its highest level since 2019. The key detail: much of the new inventory is coming from institutional sellers who bought during pandemic peaks. This explains the dramatic regional differences we're seeing. In states like New York, where institutional buying was limited, home prices are actually up 3.9% year-over-year. But in institutional buying hotspots, the numbers tell a different story. Texas, where institutional investors went on their biggest buying spree, now has 134,000 homes sitting on the market, well above the long-term average. Tennessee has 50% more inventory than normal. This isn't a coincidence. Institutional investors are quietly trying to exit before the market fully grasps the extent of their exposure. But here's the problem with that strategy. When everyone tries to sell at the same time, prices collapse. The $2 trillion derivatives risk. Many institutional investors use sophisticated financial instruments to finance their purchases: mortgage-backed securities, real estate investment trusts, pension fund allocations. The web of financial exposure extends far beyond the real estate market itself. According to Federal Reserve data, total institutional exposure to residential real estate now exceeds $2 trillion. Factor in all the derivative investments tied to these properties, and the exposure is twice what we saw during the 2008 crisis. But this time could be even more dangerous than 2008. That crisis was driven by bad mortgages from individual borrowers. This time, the so-called sophisticated institutional investors made the wrong bet. Unlike individual homeowners, institutional investors can't simply walk away from underwater properties. They have fiduciary duties, debt covenants, and regulatory requirements that force them to take action when asset values decline. The false optimism of the National Association of Realtors. The NAR is trying to spin all this positively, projecting a 2026 market rebound with double-digit growth in home sales and 4% price appreciation. But remember, these are the same people who spent the last 3 years insisting there was no real estate slowdown. More importantly, the NAR represents real estate agents who profit from transaction volume. They have a vested interest in maintaining optimism regardless of what the data actually shows. The reality is much different. When you have $2 trillion in institutional money trapped in depreciating assets, you don't get a quick bounce back. You get a long, slow liquidation process that could take years to fully play out. We're only in the early innings of that liquidation. Warning signs to watch. Here's what to monitor in the coming months. First, more strategic portfolio adjustments from major institutional players. When Blackstone's Invitation Homes starts talking about optimizing their geographic footprint, what they really mean is they need to sell properties in declining markets. Second, watch rent growth rates in markets where institutions are heavily invested. These companies bought properties expecting 8 to 10% annual rent increases. As property values decline, they'll push rents even higher to maintain returns. This creates what's called a rent displacement event, accelerating rent growth even while home prices fall. Third, pay attention to changes in institutional lending standards. The banks that finance these massive purchases are now seriously concerned about their loan portfolios. Tighter lending standards for institutional buyers means less competition for individual home buyers. The hidden opportunity. As these sophisticated investors scramble to minimize losses, they'll create buying opportunities that haven't existed since 2012. Properties that sold for $450,000 at peak are now listing at $380,000, and based on current market dynamics, could ultimately trade around $350,000. The key is timing your entry correctly. Based on our analysis of inventory trends and institutional selling patterns, the optimal buying window will likely open in spring 2026. That's when multiple factors converge: seasonal inventory increases, institutional selling pressure, and continued demand weakness to create maximum negotiating leverage for individual buyers. But you'll need to be strategic about location. Institutional selling is concentrated in specific markets and price points: Florida's Gulf Coast, Austin suburbs, Phoenix's Outer Ring, Charlotte's growth corridors. These are the areas where institutional money is most desperate to exit. Institutional sellers often have different motivations than individual sellers. They have no emotional attachment to properties. They're not trying to time the market for maximum profit. They're trying to minimize losses and meet portfolio requirements. This creates negotiating dynamics that simply didn't exist in previous markets dominated by individual sellers. The bottom line. Here's the reality. Wall Street bet $2 trillion that home prices would rise indefinitely, and that bet is now failing spectacularly. Based on Zillow data, we're only seeing the beginning of the institutional wealth destruction that's about to unfold. For savvy buyers who understand these market dynamics, the next 12 to 18 months represent a generational opportunity. But it requires strategic action, focusing on the right markets, and understanding that you're essentially buying distressed assets from desperate institutional sellers. The real estate market isn't just cooling off. It's experiencing an institutional liquidation event that could reshape American real estate for the next decade. Are you ready to capitalize on Wall Street's historic miscalculation?